Welcome to Aleasoft webinar. My name is Alejandro Delgado, Technical Director of Aleasoft, and thank you for joining us today in the second session of a series of webinars with the topic Energy Markets in the Recovery from the Economic Crisis. Today, we have two speakers from Deloitte that will talk about the financing of renewable energy projects and the importance of long-term price forecasting. Once again, the first speaker today will be Oriol Saltó, Data Analysis and Modeling Director of Aleasoft. Next will go Carlos Milans, Partner of Financial Advisory at Deloitte. And then we'll talk Paulo Castillo, Senior Manager at Deloitte. If you have any questions at any time during the webinar, please use the Q&A menu and we will answer them after the presentations. And now, I hope you enjoyed the webinar. Oriol, please, share your slides.
Good morning, everybody. Thank you, Alejandro, for your introduction. My name is Oriol Saltó. I'm in charge of data analysis and data modeling at Aleasoft, and I'll be the first speaker today. I'll go through the evolution of the energy markets in Europe during, starting from a historical perspective and how they evolved during all this economic crisis, and we will look afterwards. We'll look a bit into the future, in the midterm, and also let's see what we can say about the long term. First, a few words about Aleasoft. Aleasoft, what we are offering are forecasting services for the energy sector. We are covering most of the European markets. Our forecasts go from the short term up to the long term, so from minutes ahead for renewable energy production, day ahead for energy market, and then midterm and long-term reports up to 30 years in the horizon. We basically forecast any variable that it's useful for the energy sector, so demand and price of energy markets, also renewable energy production, and any other variable that has some kind of impact or influence in the energy markets. Our methodology, it's developed specifically for forecasting on the energy sector. The main points that, it is a hybrid model, so it combines different statistical techniques from most classical techniques like regression, time series analysis, and together with more advanced techniques like artificial intelligence and machine learning algorithm. The main points that we always want to stress about our methodology is that it is completely scientifically based, so it's based on a robust scientific methodology. Our forecasts are consistent, keep their consistency over time, and it is a proven technology that we have been using for now more than 20 years. Right now, 21 years. We started in the Spanish electricity market, and now we are covering most of the markets in Europe. We have more than 400 models in production across all the markets. So basically, we all know where we are right now. We are in the midst of the second hit of this pandemic. I was listening to the news this morning. There are a lot of countries already taking action, taking measures in order to trying to avoid again the expansion of the pandemic. France, Germany, also Spain are taking actions against the spread of the pandemic. So, as in the first hit of the pandemic that we had in March, we have to see how all these measures will affect the economy, how all these measures will affect the energy markets. So we are in kind of in a climate of uncertainty, trying to see what will be the effects now during the second hit. On the optimistic side, we are also listening to the news about how research in order to find a vaccine, a cure against the virus is evolving. So and there are important advances on this sense. So hopefully sooner or later we will have a cure. Let's take a look now on how the commodity markets has evolved. We start with the Brent oil. Here you have a historical perspective of the price. So right now, this is the year to date for 2020. Basically, we are approaching the end of the year. So basically, the price will not move any farther. So the year will end around $41 and $42 per barrel. As you can see, basically we are getting back to price levels of at least 15 years ago. And basically this is where we will end up the year. Taking a closer look of the last weeks, we see how in the price crash that we have in March, after 4 or 5 weeks, the price recovered quite quickly, and then it got stuck around $45 more or less. Right now we are around $41, $42 per barrel. So basically the average for 2020, it's going to be near that price. Looking at the gas market, the situation is a little bit different. We had peak prices, the higher prices in the last years in the second half of 2018. Since then, the price has been dropping, and it gets some kind of stable at the beginning of 2020, the beginning of this year. Then in March, we had the price crash. Sorry, it was not so steep then. Compared to the drop in the Brent price, but it also get quite low, and then it take a little bit longer to start the recovery. But once it starts recovering, the increase in the prices, it's going really fast pace. Last week we ended up above 15 euros per megawatt. Today is a little bit lower, but again, the recovery path is quite clear and quite fast. Looking at the CO2 emission right price, we see that we were having very high prices in at the beginning of this year. Then we had a sudden crash in mid-March, and then it rapidly recovered, and it recovered prices above the ones before the crisis quite fast. And right now we are at very high levels of prices, close to the higher prices we even had I don't know, 20 years ago. Looking now at the electricity prices, I will not have time to go through all the markets in Europe, but basically you can go to our website. We have the energy markets observatories. You can find the evolution of the prices and demand and all the important variables for the last weeks. So basically you can see there the evolution. I will not have time to go through all of them, so I will just have a kind of a summary of a global view. Also, our clients, we are developing a platform where clients will have access to the whole history of every variable with different granularities, and will also be able to do more advanced analysis. So looking at how is behaving the electricity demand in the principal in the main European markets since February until October, month to date. So basically we see that in most of the countries the electricity dropped. The peak of the electricity drop was around April, May, depending on the country. Some of them reached close to a drop close to 20%. Others were around 10%. And looking at the recovery, what we see is that some of the countries are at demand levels still clearly below the ones that we had in 2019. For instance, Italy, Spain, also United Kingdom are still around 2, 3, 4% the levels of last year. But there are some other countries where we see basically a full recovery of electricity demand. We're talking about France, Germany, also Portugal, Belgium, Poland. So basically, except for Portugal, countries in the center and north of the continent are, in terms of electricity demand, we can say that they are kind of fully recovered. Some of them are still, as we see, a little bit below the 2019 levels. Looking at the prices, we see similar behavior. There we have some countries, mainly France, and all the countries interconnected with France. So Germany, UK, Belgium, Poland, that is connected to Germany. These countries already exceeded in the last month the prices of the last year. Right now are more or less at the same level. But looking at the countries in the south, in the southern part of the continent, we can see like Italy, Spain, Portugal. All these countries, all these markets are still at least 20% below the prices of last year. So we are seeing kind of, let's say, two speeds of the recoveries. It's also important also to notice that the recovery of the prices in this market was mainly due to the price in France. That's some kind of pushed up the price of the markets around it. Basically, it had some issues with its nuclear power supply. So, but okay, we are seeing kind of two speeds in the recovery of the electricity prices. Looking at the future markets, for instance, the forward curve for the oil market, we see that obviously during the crisis, the forward curve in the mid and the short and the mid term went down. Right now, we are kind of recovered the previous levels of the forward curve, but we are seeing maybe we have some decrease in the prices at the very long term. But anyway, the situation at the long term didn't change much during the crisis. Similar situation with the gas prices. Right now, in the midterm, the curve is fully recovered, and at the long term, we are seeing some variation. It is nothing significant. This has occurred also in the past, but it was quite stable during the crisis, and right now we are seeing maybe some kind of uncertainty also in the very long term. Looking at the forward prices of the electricity markets, this is the power market for futures for next year. Here we have the price drop that we had in March, and then after that the prices went up, fully recovered already, but by July. Right now last month we were at the same levels or above the levels pre-crisis. Right now we are seeing a little downward trend. So looking now a little bit into the future, what can we say for next year and the following years? Again, I will not have time to go through all the markets. I usually show the recovery of the demand that we expect in Spain. It is kind of one of the countries with severe drops in economy and also in electricity demand. So it's kind of illustrative. So the electricity drop in the demand drop in 2020 will be around 5% by the end of the year, and the recovery for 2021, depending on how fast the economy recovers, is going to be around 2, 3, 4%, depending on how the economy recovers. So what are the key points in order to forecast the power markets? So we have seen how CO2 prices are, gas prices are rising pretty fast. they will not go up forever, but still we see some room for prices to go a little bit higher. CO2 prices are already at very high prices. Brent oil prices are kind of stuck, so we see they will end the year around this 43 euros dollars per barrel. We have seen that some countries has already reached last year prices in electricity demand, some of them not yet. This is probably because the economy is not recovering at the same pace in all the countries. So the recovery rate of the economic crisis will lead to different rates in recovering electricity demand. In electricity prices, we have seen again how some markets are already at the same level of last year. Some of them are still clearly below. We're talking about 20% lower prices. So basically, what we are seeing, summing up all of this, is that we are seeing a very large uncertainty, mainly in the short and the midterm, due to this second hit of the pandemic, the measures that the governments are taking, how will they affect the economy and the energy markets? This is kind of a large uncertainty that is posing in the evolution of the demand and prices. So this is where we are right now. Looking more at the long term, we see that even though there is an uncertainty, the equilibrium prices at the very long term are really similar to the ones we were seeing before the crisis. Looking specifically at the energy sector, we have seen how the prices have been affected for the drop in the economy. But anyway, we have seen how renewable capacity is growing, projects are being developed, banks are wanting to finance new projects. So there is kind of an inertia in the energy sector that it's keeping the things going. But anyway, there's an uncertainty, we cannot doubt about it. And just a note on how important it is to have reliable price forecasting for at the long term. It is important because having robust price forecasting, that is a critical input for financial models. You are designing a financial model for your project. Have one important crucial input is the price forecasting. So if you have robust price forecasting, you will have a robust financial model. And renewable energy projects, if designed at the long term, they are still profitable. They are feasible. Obviously, we are not seeing the annual returns that we were seeing in 2018, where we had prices double the ones that we have right now. But at the long term, they are still profitable. And okay, summing up and just remarking some of the things that I've said, we have seen some indicators like energy prices, energy demand, that point that we are kind of in nearly to a full recovery of the market. Probably yes, but this recovery, the roots of this recovery are not in solid ground. So the ground is kind of slippery. We are just in the reaching the highest point of this second hit. So everything is uncertainty. It's uncertain. So price crashes, that the ones that we saw in March and April, are still possible. Let's say we are not sure about how these measures are going to affect the economy and how are going to affect the energy market. So the scenario is uncertain, and we don't know if this second hit, in this second hit, we will be the second dip in the W, the famous W recovery scenario, where we have our first dip in March, and maybe now is the time for the second dip. We don't know. As we have seen, anyway, renewable energy projects are, the rate of new projects is progressing well, it's advancing. And just remember how important it is to have reliable prices, reliable price forecasting in order to have reliable feasibility studies about your future projects. And just let me end inviting you to our next webinar. It will be held in November 26th. We will be closer to the end of the year, so we will be focusing on what will happen in 2021 and next years. If you can register in our website or just write an email to us. And that's all. Thank you very much for your attention. I hope you found it interesting.
Thank you very much, Uriol. Thank you for the presentation. It was really good. Carlos, when you're ready, please, you can share your slides now.
Yes. Good morning, everybody. Let me just try to present my screen there. 1 second. Okay, I hope you're just watching now my screen. So first of all, a few thank you words for Aliasoft for inviting Deloitte to be present in these interesting events, e-events. Since now we cannot meet together and keep the social distancing, but it's always important just to share what we are thinking all around these type of calls, so we can still push the sector that we love so much and in which we work. Okay. So thank you again, Aliasoft, for inviting Deloitte. First, one second. Let me see if I can move to the next slide. Yes, just a brief comment about Deloitte as a firm. Okay, I'm new to the firm. New to the firm means that I'm here for 2.5 years, and most of the partners have been with the firm for at least 20 or 25 years, which is an honor to be part of this firm. And I'm bringing the experience that I have acquired in the past in the investment banking industry and working in renewables since late 90s, right? The thing I wanted to show you here is that, and it's my personal experience as well, when I joined the firm, I didn't was much aware of all the services that we can provide, and particularly in the renewable energy space, we have capabilities that go from the A to Z, so all the life cycle of the project, starting with permitting and licensing. I find out not recently, but a year ago, that we do have, for instance, a tool that can superpose different layers of information of terrain, what we call the catastro, irradiation levels, orography, and many things, so we can probably faster the identification of ideal or adequate sites for renewables. We can assist you with all the paperwork and administrative work in relation to the public administrations, from land procurement, point of contact, of connections, etc. We can provide due diligence services. Most of the people, when they think about the Big Four and particularly about Deloitte, they think about an audit firm. In fact, only 20% of our revenues are coming from audit, and 80% are coming from professional services, like the ones we will show you today, right? So just a snapshot that we can advise you on the early stages of a project through the engineering and development. We do have a team full of engineers that can help you with the design, project contracts, checking KPIs, level cost of energy, cost of EPC wrap contracts, particular equipments, etc. We can also help you on the financing. That's my specialty. So we can certainly help you on the M&A process of acquiring a project, including all the diligence associated to it. We can help you finance that. We can help you structure a project financing and a PPA, as we will see in the next slides. We can also, along this, help you on the complex accounting advisory that is now required for renewable projects because of the presence of PPAs and hedging, how to show that financial information and reporting. Then once we reach a financial close and we initiate construction, again, the capital projects team can help you with all the construction management, milestones, claims in case of the discrepancies with the construction company, and so on, right? Then on the operation phase as well, we can advise you, providing accounting, tax, legal services, and ultimately help you out, either exit that project and again on an M&A, or going public, IPO readiness, and we have very recent stories about this in the market, and it's more and more common to see companies active in the renewable sector just to go to the public and list their companies, right? So that's as for Deloitte. So think about us as a full service provider, not only as an audit firm, please. Okay. So the content of my presentation is going to be first a little bit of context that Aliasoft has already expressed. Grid parity is now a reality, and this is the most important thing that now enables a project to be on a standalone basis to compete one-to-one with the most efficient thermal generation assets. Okay, this enables decarbonization. We do have ambition targets. We all know that the PNIEC, the National Energy Plan, depicts over 50 gigas of additional renewable to be installed in Spain. This is going to require massive investments on the side of the sponsors in the form of equity and on the lenders in the form of debt. Okay, and then grid parity is a reality because feed-in tariff was the remuneration schema only a few years ago, and now we are immersed in market prices and merchant risk. This, and I'm not going to spend a lot of time on this one. Aliasoft is the expert in forecasting pool prices, but what we can see here is that from the beginning of the market in the year 98 down to today, we have seen some volatility. Average price was 46 euros per megawatt hour, volatility plus 13, minus 11. Now we have, beyond the pandemic, that is a point in time, and certainly I want to see it as a catalyst to the acceleration of what may come in the renewable space and the acceleration of the installment of additional renewable capacity. But I think long term, the investment thesis is still intact. We may see different speeds at which different events may evolve, and the pace and the amount of new megawatts, it will be different, and therefore the different scenarios. But here, what is clear is that there is a lot of uncertainty around pool prices going forward. I fully agree with the messages passed by Aliasoft that it is very important to have reliable pool price projections in order to have a good visibility on expected returns, right? So how do we do it? How we do accomplish such a massive investment in renewables? It is a challenge. Good thing is that we in Spain, we have all the ingredients, right? We have good renewable resources, either solar and or wind. We have good technology. We have certainly the human capital because of the renewable boom that we experienced in the late 90s and early 2000. There is a lot of Spanish corporates that are top tier one companies in this sector. So we have all the talent available to be a hub for renewables in Europe and I could say also for the world. What else do we need as ingredients? Okay, we need good policies, no? Regulators or the absence of a strong intervention, it is advisable. Okay, so planning, legal security, investments in the network, manageability, storage, taxation. I think now, for the first time in many years, we are seeing that the politicians and the regulatory bodies are all aligned towards pursuing the ambitious targets for decarbonization the planet in 2050 and good objectives at sight in 2030. So I think on that front, no matter what government, we all think that they will help push the renewables going forward. And ultimately, a lot of money. So we need a lot of equity and a lot of debt, okay? Money obviously seeks for a certain return, okay, and has an opportunity cost, and this is very important, okay? So because we will see that expected returns in an environment like today's of uncertainty and volatility is not always easy to keep track on, right? And to avoid surprises, we will show you, the right steps towards achieving a good financing and securing expected returns. Merchant risk, therefore, is the new player. Feed-in tariff disappears. Volume risk is accepted. Do not forget that any revenues is price and quantity. So in terms of quantity, I think there are many different third parties that can predict energy yield from either PV assets or wind assets. And I think that the probability associated to those scenarios is widely accepted. It is something that has been done for the last 20 years, so widely acceptable, but price risk, not so much, okay? So this is the major disruption for shareholders and lenders, okay? It's absolutely essential to have a long-term view on electricity prices. So again, full alignment on Aliasoft message. How do we finance then merchant risk, okay? 2 slides here. On this one, I will say the easy part, okay? We may all agree that both CapEx, OpEx, tax assumptions, we can probably discuss generation tax as a separate issue, but in general, CapEx, OpEx, and tax assumptions are shared by both providers of capital, shareholders and lenders, right? Always subject to independent third-party validation, due diligence, etc. But we may assume that we all know how much does it cost to install 1 megawatt of wind and 1 megawatt of solar PV with, without trackers and so on. We all know more or less the OpEx associated to it. So it is kind of a standard. So it's easy to project those parameters. Okay, so with the exception of minor difference, okay, in relation to tenor, okay, PV probably a little bit longer tenor than wind, and cost, financing does not differ much between lenders. So most of the lenders, except for their approach to merchant risk, will have, you know, the same parameters for financing these type of assets, okay? And in terms of quantity, as I said, lenders use P90 while shareholders tend to use P50. That's the easy part. And here comes the not so easy part, right? Which again, the key feature there is pool price, which is assumed by lenders for calculating the amount of debt that they will lend onto your project, and the pool price expected by shareholders for their equity return calculations, okay? Shareholders need to have, by definition, a more optimistic view on pool prices, so they can mobilize money and they can convince, if, for instance, we're talking about a fund, convince the investors to mobilize money and put money at work and invest in renewables, okay? However, at the moment, we see a significant difference or mismatch between the long-term pool price forecast that the lenders assume when calculating the amount of debt that they can put into your project and the pool price that shareholders expect to occur in the future for calculating expected returns and therefore taking that final investment decision, which is a key moment for shareholders. Okay, this situation, the fact that the merchant risk is the key issue and the key risk to be assessed, makes essential the presence or the contract of PPAs on the long-term pool prices, especially if part of the project wants to be financed with non-recourse debt. Okay, certainly there are a few players, large utilities that can fully finance renewable projects on full equity and use corporate debt. We're talking about the rest of the investors that certainly need to mobilize capital along with non-recourse debt. Current situation on how these lenders are approaching the financing and the merchant risk altogether. So banks available to finance renewables on a full merchant basis, we can count them with one hand. Okay, between 2 to 4 banks, okay, can really tackle this merchant risk, and they have their own pool price projections and feel comfortable assuming that risk. Okay. Little market depth because a small number of banks and therefore a small consolidated amount of money that can be deployed on a full merchant basis. Okay, particularly on a per project basis, I think that financing a project larger than 100 or eventually 150 megawatts without a PPA will be challenging, not impossible. We did one of a 315 megawatt wind farm without a PPA, but in this particular case, the sponsor is a listed foreign company, wanted to mobilize a strong amount of equity. So it didn't matter for them to lower the amount of debt that could be raised against a full merchant project. Okay. In any case, if a project is financed on a full merchant basis, the lenders, you can assume that are going to apply conservative debt sizing assumptions, therefore leading to a lower than desirable amounts of debt. Okay, so most of the projects, either larger projects and then sponsors that need that extra pickup of debt to finance their assets, are going to need a PPA in their structure. So here we find more banks, okay, at least 6 to 8 banks and many others joining. So there's greater market depth. You can access multilaterals, okay. Multilaterals are also there to help all this renewable boom happen, okay. However, they also are very moderate in relation to their appetite for merchant risk, okay. Here, and is curious, while on a full merchant basis, you can go up to 100 megas on a PPA deal, finance with project finance, you have a limitation on the top. I would say that 300 to 400 megas produces a significant amount of gigawatt hour per year, and covering that through a single PPA counterparty will start be challenging beyond that 300 or 400 megawatt deal. I don't know if we will see sooner rather than later, as we have seen in the financing market for many years now, a club deal in PPA, so more than one single off-taker be present in a large project, sharing the same risks. Okay, so trying to add together capacities on the buyer side and having more than one off-taker. Will be glad to start working on any of your projects in that sense, because I think is the only way to accomplish a project financing for very, very large projects without incurring much merchant risk. Okay, PPA's price levels are somehow erratic due to high PPA demand. It's a buyer's market. Okay, just a small number of counterparts and a new environment of volatility and uncertainty makes this market also a little bit of a bumpy road. Okay, so the approach for financing a deal with a PPA, my recommendation will be is a tailor-made exercise. It's not only about price, tenor, and volume. There are many other terms in a PPA that are complex, and I strongly advise you to get an advisor to go through that hiring of a PPA or contracting a PPA for your project. Here's some relevant information in our view. PPA market overview. There have been a lot of PPAs already in the market. It started in the year 2018. Different structures, swap, floor, and a combination of swap plus floors. Okay. Here you have the benefits of either structures. Okay, swap certainly has better leverage, most frequently used, possibly better accounting treatment. I will let Pablo afterwards to comment on this. Certainly worse equity IRR because of the loss of the upside potential. Right, you are exchanging a variable price for a fixed one, so you know what you're getting. But if the pool price goes high, you are losing that upside. Okay. In terms of prices that we are observing today, 10-year swap base load in the region of 39, 40s, 38s. Okay, if we talk about pay as produced, which is one of the preferred routes, especially for PVs, so you get rid of the capture rate risk, we are seeing low prices as low as 32, 34 euros per megawatt hour for PV projects. Okay. There is a possibility of structuring decreasing prices and try to replicate the risk associated with time. Okay, but in summary, those will be the levels that you could get today for probably start dates on PPAs for next year and eventually 2022. Okay, floors, better return for shareholders because you keep all the upside, are simple to structure, are increasingly frequent, and you get all the full upside potential for the sponsor, not for the project. However, it will result in lower leverage. You need to pay a premium, as in the case that you hire an insurance for your house. This is an insurance protecting you for the pool price going below a certain level. So you need to pay a premium upfront, and that is going to be an OPEX of your problem. Okay. Possibly worse accounting. Again, I will let Pablo to comment on this. Not available for many off-takers. These are options. Okay, so not all the off-takers have a good envelope for doing these structures. So you have less potential counterparties available for providing a floor. Okay, and then high volatility on floor quotes and associated premium, specifically because there is a lower number of players that can do this. Okay, in terms of prices that we're seeing today in the market, we're seeing around 30 euros per megawatt hour for floors of 10 years on a base load basis. and really down to 24, 25, 26 euros per megawatt hour under pay as produced. These are net floors. So this 26 is that you will have in a structure maybe 32 and 6 euros premium. So that 32 minus 6, you will end up in 24. So at the end of the day, you will need to pay the premium up front every year. So net floor is what you want to have in your mind in order to calculate potential returns. And then where do you want to cover yourself, okay? Certainly premiums on the floors depend on tenors and forward start dates. And you can always pair different combinations of gross floor and associated premium to end up in net floors of around those levels, okay? We have done only once a premium subordination, so the leverage is calculated based on gross floor. Let me explain. If you can have a floor at 35 with a premium of, let's say 7, okay, you can size the debt on the 35, okay, and then subordinated the payment of the premium in the cash waterfall in your project, okay. You may improve the floor levels by reducing the premium and granting a put. And then you can also do what we call a put spread. So it's granting is a structure where you have two floors. So you have a protection between two different levels, and below the second floor, you are unprotected. That may work well with those lenders that have their own view on pool price and don't think that the pool is going to be at 15 euros or so. So they don't need protection, and therefore you make some economics on the premium. Okay. Then I think that one of the most interesting structures that we can apply to a project today is having a swap in the initial years, taking the benefit of the price indications offered by the futures market, by OMIP, and then a floor in the second part of it. So a 5-year floor, 5-year swap followed by a 5-year floor. Okay, you will keep all the upside on the second part of your structure while securing reasonable levels for 5-year swaps nowadays. 5-year swaps probably in the level of 41, 42 on a base load, and net floors around 26, 28. Okay, so these structures allow you to keep the upside potential on the second part of the structure, which is good because is where the most of the uncertainty is. If you are a very optimistic investor and you think that prices are going to be keeping at 45 level, go for a floor and keep the upside. Okay. In relation to tenor and bankability, swaps for 1 to 5 years are highly liquid, but they have low bankability. Don't forget that project finance lenders, since they lend on a long-term basis, the fact that you secure pricing for only 1 to 5 years is irrelevant for them. Okay, tenors on 5 to 10 years, moderate liquidity, moderate bankability, and the sweet spot is between 10 and 10 years. I would say that the start today is 10-year PPA structures. There is improving liquidity, so many of takers offering products on a 10-year tenor, and therefore is highly bankable because you already secure a good part of your tenor, the price in a good part of the tenor of the debt. Okay. Here we have assumed, now we'll go to an interesting part that will end up in some IRR sensitivity analysis. As we said before, project assumptions are more or less a standard. We have commented on debt sizing assumptions in terms of tenor, 16, 18 years post-COD. Always you will have a cash sweep in order to reduce that tenor via cash sweep to something more reasonable, let's say 13 to 15 years, which is 3 to 5 years post the end of a PPA. If using P50, this will be the debt service cover ratios that you will be required from lenders. 130 for contracted cash flows, 150 for merchant cash flows. And in general, this, I'm sure you are all aware, and the presentation will certainly be available afterwards, so not need to concentrate a lot of time. Maybe just one mention on PPA volumes. You want to avoid an overhedge situation. So typically, project hedge P99 production of the project or a 90% of P90, but never 100% of it. Okay, because if you end up producing less, you will be potentially in a situation where you will have to make settlements on the PPA without producing the whole amount of energy that you have covered. Okay, so here PV project assumptions, standard 30 years, 2,000 hours, capex in the region of 575 euros per megawatt peak. We have assumed 40,000 as development fees, okay? There are many people out there buying now projects with land secure and connection point at those levels. So I think that is important to add at least that extra amount to the PPE, property, plant and equipment, in order to understand the return calculations that we're going to show you in a minute. Wind assumptions, again, we are seeing now 30 years operational life, 3,250 net equivalent hours. We have seen a good progress on the amount of energy that can be produced on the same site, okay, by increasing the machine height and the diameter of the blades, okay. CapEx, however, hasn't moved that much, 1.1 million per megawatt, same development fees, okay, and similar in terms of debt tenor. If any difference, I would say that debt tenor for wind can be a little bit shorter than PV, okay, because certainly operation and useful life is a little bit more complex, but beyond that, similar situation there. And here, and we're just about to finish, this will be the sensitivity tables for a wind deal and a solar PV deal, okay, with nominal capture prices. And I want to emphasize that these are nominal capture prices because it's not pool price. Certainly capture rate risk is something to take very much into account. So depending on which is your view on how cannibalization on PV is going to affect the market and how much of the pool price you're going to be able to capture, this is the money that the project will be capturing for the amount of hours that will be producing energy, okay? So capture prices on the left, and on the horizontal axis, the number of P50 production net equivalent hours, and the resulting equity IRR, excuse me, resulting equity IRR, and the amount of debt that you will be able to secure under these different number of hours in your project. Okay, obviously the larger the resource, either solar or wind resource in your project, the larger the amount of debt that you're going to be able to raise, okay? A preliminary conclusion here is that at levels of capture prices between 35 and 40 capture prices, you still have decent returns. Certainly, it's no longer a two-digit business, a two-digit return business. It's a single digit, as also expressed by Aleasoft, okay? So full merchant projects up to 100 megawatts, not too easy, not too many banks being able to provide a full merchant debt. If we put a 10-year swap pay as produced on top of that very same project, you will see that the equity IRR improves, okay? Improves, but you are still destroying value, okay? Because of the low prices that we can get today from off-takers, okay? So IRR improves and protects you from low prices on a 10-year swap, but certainly you are giving up some pickup of profitability if pool prices are high. On the other way around, if you want to keep all the upside and you implement a 10-year floor, although it's not a typical PPA that can be offered by many off-takers, okay, you will see that you protect your profitability in case of very low prices, okay, and you keep all the upside. Certainly has the drawback of paying a premium, and that obviously has some effects on equity IRR. But again, you will see that you still have decent return figures, okay, at reasonable levels. And here is the option that we like best as of today, which is combining a swap in the initial 5 years and a floor on the second 5 years of the structure. And you will see that equity return increases slightly, and you have a good protection, especially on the low side of the pool prices. I haven't put a translation of how this translates into percentage of leverage, because it's a result that many people wants to talk, but I think it's more intelligent to talk about amount of euros per megawatt that you can get on your structure, because it may excuse me, it may happen that you have a project that is expensive for whatever reason, long distance to the connection point, or you did pay a very high premium when acquiring your project. So I think it's better to calculate the amount of debt that you can raise, multiplying these amounts that you see on the bottom of the page by the installed capacity of your project. Conclusion, and this is the end of my presentation. Renewable projects are still viable on a standalone basis, regardless of how you finance them, full equity, merchant, or merchant and PPA. So the use of a PPA is advisable for larger than 100 megawatt projects, although it destroys value for shareholders at current prices, okay? So in essence, the evolution of the electricity futures market, the implementation of energy-based auctions, the match-awaited auctions, and a greater appetite and understanding of the merchant risk by both capital providers, investors, and lenders will be key in the development of renewables going forward. And thank you very much. We'll be happy to answer questions after the presentation.
Thank you very much, Carlos. Very complete view of Deloitte. And now, Paulo, we continue with the presentation. Please share your slides.
Hello, everybody. Thanks for the opportunity. Let me just switch to the screen. Do you see the presentation already?
Yes, it looks good.
Okay. Yeah, thank you so much. Well, first of all, I would really like to thank Aleasoft for the opportunity to share views, as Carlos has mentioned, in this energy renewable sector that is quite challenging, and it has a lot of initiatives and future forecast in terms of investment and companies' growth and opportunities. So let me introduce myself quite quickly. I'm Pablo Castillo, Senior Manager at Deloitte, and working in the capital market department, which is in charge of providing assurance on international accounting standards and going to public offering in terms of debt and equity. We usually work as an auditor and advisors in all type of customers, small and big, and we usually are assisting in the whole process from the beginning to the end. And recently, in the last 2 years, we have been helping some of the two public offering assistant to a Spanish company in the market. So what I will just cover quite quickly, it is regarding the financial information and all the issue that we are seeing in this transition from feed-in tariff structure to PPA structure. What is really needed and what are the key challenges for everybody in the market. So first of all, I will just put an overview, quite obvious, that what we see in the market. We are dealing with small players working in the same league with international groups. And despite the fact that the site is very different, the rules in terms of financial information and the expectation of the user are the same. So it is especially quite challenging for small companies and small projects. So what are the main spectators? I think it is obvious. It's investors, banks, and regulators. But I think that is quite clear to keep the focus on that, because what we are seeing in the last 5 years is that there's a lot of small companies that apparently just recognize the financial information that they are registering as a, let's say, regulatory compliant issue, and nobody focus on it. No? But what we see with all the investment fund that are and banks that are seeking for opportunities and the growth market, we see that the financial information is the only thing that they provide quite granularity in the information that they need for the decisions. So what do they expect? For sure, they expect what is the risk exposure and that you are dealing in the project, the investment performance for all of these structures. if there is a regulatory compliance going on, and which is the business performance. I think that everybody think about the financial information as a static view, but take into account that there's a lot of comparability year to year, or the evolution and forecast, including the financial information packages. They are also seeking for transparency and comparability among all the current market participants. And what we really think is the accounting is critical info for that. So if it's not at the beginning, there is going to be really a really important moment that we will share right now, that the assurance is going to be required. So I think that we will need to be focused on all the aspects and the complexity that has Carlos mentioned previously. So what are the moments that matters on accounting? I think that everybody might be thinking of the closing of the years, or the annual report that we just register and go to the commission and so on. But you think about that there are quite a big moments that they are relevant. Okay. Speaking of the inception of the transaction, speaking of the contract of the enter into a PPA, what we are really seeing is that the principles that you said at the beginning and this inception of transaction is going to be key for the accounting treatment in terms of classifications, valuation, and the starting point for any deviation for seeking the investment performance or business performance, and an impact on the future of this decision. So I think that in the inception of the transaction, most of the time is not taken into consideration quite close. Then, of course, we have a closing of the different accounting periods. What we just realized that the procedures and the consistency for all this information that you need to manage is quite clear. You don't have only just to capture all the information at the closing of the period, for example, on an annual basis, but also what are the situation and the condition that was at the inception of the transaction, and so on. So there's a lot of procedures and consistencies need just to keep on going for the full investment project. Then we are used to deal with debt or business restructuring that it doesn't need to be focused on just when the business is going wrong. We are seeing a lot of initial project that at the end of the construction phase, or when the things are getting quite reliable, they go through a restructuring just to get some benefit on the market condition that they can get in that specific moment. So there's a lot of cash and equity impact that might not be aligned, and it's quite clear to have a view on accounting and the cash outflows or inflows, because some of the decisions might be different depending on the view that you are considering. Another important issue is that we have a lot of merger and acquisition in this market, especially in Spanish one, where all the assets and liabilities that has been created for a small project have a really a strong challenge on valuation at that moment for the merger and acquisition. So all the principles that you said at the beginning for all the accounting treatment or for all those PPAs would be an issue to take into consideration for the valuation, not just for the price mechanism of the transaction, but also for the future equity impact that might appear depending on the accounting transaction. And last, what we have, and we have a quite strong experience on that, is that any kind of public offering regarding if it's debt or equity, I think it's just quite challenge demanding process, because there's going to be a much more focus on the assurance and approval of the commissions, and it's not going to take only the moment of the IPO or the moment of the debt issuance. It's going to be just a review of the past period and present assurance. So I think that all these moments are relevant, and all the things that you said at the beginning or during all the closings could be challenging for those situations. So I think that a quite important message here is that we are used to, for example, work with big companies, and we have which they have really strong teams on financing and accounting and so on. But all these principles, procedures, and consistency, and all this transaction, theoretically, the site does not care. So it means that a small plant or a small project investment would need to take quite close those principles and procedures and consistency on the accounting standard requirements, despite the fact that they don't have such a big a strong team on behind. Okay, so I will just go a little bit on the technical aspect of this accounting treatment for the PPA purchase agreement, because I think that we are seeing a quite transformation between the past structure in big projects to the current market. I think that everybody is understanding or the common player on the market is just assuming that there is a PPA is a simple buy or sell electricity contract at a fixed price. But as we have seen in the presentation of Carlos, and also in the volatility that we have seen in the forecast of Aleasoft, is that every PPA in the current market, it's quite a tailor-made contract. So we are just analyzing that there is a lot of variability in quantities and maturity, deliveries, price, settlement. So these futures can create really not a unique classification. Just as a summary, what we can have is an executive contract, a concession agreement, a lease contract, and a derivative, or just inside of those executive contract, concession agreement, or lease, we can have embedded derivatives and come up again finally just to account for this instrument, not just as a simple supplied agreement, but just as a financial instrument that creates quite a lot of complexity in the estimation and volatility in equity or P&L. So what are the material judgment and estimates that we are facing on those type of contracts? First of all, the analysis at the inception of the rights and obligation is quite hard, because as we mentioned, all the characteristics are unique, and there's a lot of clauses that change cash flows or guarantees or price or estimates. So another point of view is just the estimate of future cash flows. I think that I need to be focused on here, because we usually get from analysts and from investors quite a trend in the view of the market as an overall, like, for example, just checking for price in an overall, for example, which is the average price of this year, or which is the forecast for the next 10 years. But in accounting, I think that the granularity of this forecast is going to be sensitive, meaning that if we are, for example, in a solar farm, we need this granularity of these estimations in terms of hourly profiles, and how it's going to be captured the volatility on the market in the financial statements. Also, I think that a lot of people is struggling with the valuation, because they see the market as a unique market with just a unique curve, and it doesn't matter the instrument you are evaluating it. As Carlos has mentioned, it depends if you are entering into a base load or an hourly profile contract or a pay-as-produced contract with different options or limits or threshold for the price mechanism. I think that everybody needs to think that there's a lot of margin on that, premise on that, that need to be considered not only at the inception or not only at the closing of the year, but also how is moving this component among the years. And I think one of the struggling point also here is that, okay, if we have a derivative, the easy part would be just to try to adopt hedge accounting, which create less volatility in P&L and just try to put all the variability in the equity. But it's not an easy, or at least it's not so similar to the short-term contract than the long-term PPAs. And for sure, there's quite a lot of material adjustment and estimates in the accounting entries procedures, and also how you disclose this contract and those principles that you said from the beginning and all the transaction. So just to finish, I think that everybody needs to think that what if we become different, meaning that we are a small company, growing quite fast, doing the things between a small team, and what is happening when I get to different type of project contracts in different jurisdiction with different regulation, market condition and estimates and deal negotiation. So I think that everybody has a view that not in all the countries the transaction will be similar. The estimates of the information available is not that robust in different countries. But at the end of the day, in terms of accounting and financial information, what you really need is just to have a clear and accurate view on accounting before the transaction are signed off. Because especially when you consolidate all the information for the stakeholders, there's a risk of inconsistency in those estimates or those presentation of this contract that might be similar, but at the end of the day, the measurement could be really different. And for sure, there's also a need to think about the estimates and the forecasting uses a single chunk of information, because you are using different type of processes. For example, in budgeting, impairment test, and derivative valuation. So if you use quite different source of information, you might have quite strong problems in the financial statement because are inconsistent. So just a final remark, I think that we really need to be quite aligned on the business process, accounting, operation, and public information reporting, because it might not be the case when you enter into the investment, but if you are entering into a merger and acquisition process or an IPO, I think that some of the issues that you take into account at the beginning might appear not properly deal at the beginning. Thank you so much for everybody.
Thank you very much, Pablo. Great presentation. We have exceeded the time schedule today, but I believe Uriol has a very interesting question that he wanted to reply. Uriol?
Yes, okay, I'll be the only one answering a question. So the question is how probable it is to see new prices drops in power markets and CO2 market. Okay, as I said during the presentation, that I think they are probable. So compared to the price drop that we had in March, it will, I mean, from March to now, comparing March to the situation right now, we are, let's say, at a similar situation in terms of spread of the pandemic, but we have a lot more experience. So the actions that the governments are taking are, at the moment, are a bit less strict than they were on March. So the impact on the economy, it will depend. If the impact on the economy is the same, probably we will again see price drops in the energy markets. In the CO2 markets, on the other hand, it's kind of a different market because it basically doesn't exactly respond to supply and demand of allowances, but it's kind of a speculative, more speculative market, not in the bad sense of speculative, but basically people are buying and selling in order to get profit. So maybe a price drop there, it's more probable, but as we have seen in March, a price rise is also probable. So summarizing, yes, but maybe if they are, maybe there will be no so deep that the ones we saw in March.
Okay, perfect. And we will answer the remaining questions directly by email. Thank you again, Oriol, Carlos, and Pablo. It was great to have Deloitte's view for the coming years. Thank you for your presentations and the audience for joining. Have a nice day.
Thank you.
Thank you.
Thank you so much. Bye.
Yep. Bye-bye.